If you've ever wanted exposure to Warren Buffett's Berkshire Hathaway portfolio and monthly income on top of it, from a stock like Berkshire that has never paid a dividend and has no plans to pay a dividend in the future, there's a brand new ETF that might catch your attention. It's called the VistaShares Target 15 Berkshire Select Income ETF, ticker symbol OMAH, and it officially launched in March 2025. OMAH, or OMAR, as it is famously known, is actively managed with two clear objectives: generate high monthly income as its primary goal and provide long-term capital appreciation as a secondary objective. The fund mirrors the 20 largest Berkshire Hathaway holdings, names like Apple, Coca-Cola, Bank of America, Chevron, and even Berkshire itself. On top of that, it layers in an option strategy primarily selling covered calls and spreads, with the goal of producing around 15% annual income, or roughly 1.25% each month. Now here's where it gets interesting. From March 7th to August 26th, 2025, OMAR has actually outperformed Berkshire Hathaway Class B shares. During that period, Berkshire posted a negative 1.64% total return, slipping into the red. Meanwhile, OMAR finished at positive 4.27%, thanks in large part to those monthly distributions. That's about a 5.9 percentage advantage in OMAR's favor. While Berkshire's stock pulled back, OMAR stayed positive because its payouts helped cushion the dip. The income didn't just smooth out the volatility, it gave investors a stronger short-term total return than holding Berkshire alone. When it comes to long-term performance, few companies can hold a candle to Berkshire Hathaway. Since 1965, Warren Buffett's empire has delivered an unbelievable 5,502,284% gain, a number so staggering it almost doesn't seem real. To put it simply, Berkshire has completely outpaced the S&P 500 over that time frame. But here's the thing, while Berkshire's long-term dominance is undeniable, its pace has cooled in more recent decades. Over the last 30 years, Berkshire has grown at a compound annual growth rate of about 9.92%. Now, fast forward to 2025, and Berkshire's Class B shares are trading at around $488. That represents a 2.57% gain over the past 12 months, with about a 3.48% increase year to date. OMAR is basically Berkshire with a paycheck, income, and exposure all in one. So where does OMA actually fit in for investors? This ETF could be appealing if you're looking for regular monthly income, and you're okay with giving up some upside in exchange for that steady cash flow. It's also a way to get exposure to Berkshire's top holdings: Apple, Coca-Cola, Bank of America, Chevron, and more, all bundled into one product. And if you understand how return of capital distributions work, including the potential tax deferral benefits, then that structure might make sense for you. There are a few things to keep in mind. OMAR is concentrated in only about 20 stocks, which means it's more vulnerable if one or two names take a big hit. At its core, the fund is built from a mix of Berkshire Hathaway Class B shares and the 20 largest equity positions in Berkshire's investment portfolio, as tracked by the selective VistaShares Berkshire Select Index. The goal is to replicate Berkshire's disciplined, value-driven investment style. It leans heavily on an option strategy, which can generate income but also introduces more complexity and potential risks. And finally, it's a new fund with a limited track record, so we don't yet know how it will hold up through different market cycles. So while OMAR checks the boxes for income and Berkshire exposure, investors should weigh those benefits against the risks before making it part of their portfolio. So here's where I land on this. I'd say OMAR is best suited for investors who want reliable monthly income, love Buffett's style of investing, big, durable companies like Apple, Coca-Cola, and Bank of America, and don't mind using a newer ETF with an options overlay to squeeze out extra yield. But if you're the type of investor who just wants to ride Berkshire's legendary long-term compounding story, without the added complexity of options or a new fund structure, then sticking with BRK.B might be the simpler and safer choice. At the end of the day, I could be completely wrong. OMAR might just keep building on its early lead. Do you stick with the proven stability of Buffett's legacy, or do you take a chance on a brand new challenger that bakes income right into the strategy? One path has history on its side. The other could be the what-if story we look back on years from now. As always, this video is for entertainment purposes only. It's not financial advice. Always talk with a licensed professional before making any investment decisions. If this video gave you any value, do me a favor, hit that like button, subscribe, and tap the notification bell so you don't miss future breakdowns like this. Catch you in the next one.